Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Monday, May 5th, 2025, Cinco de Mayo. Today's episode, the Fed can't cut. Stocks are too high. Many people, including myself, are surprised to see the S&P 500 at the same price that it was before the tariffs were announced in the first place. This rip your face off rally, as they say, caught me off guard. I didn't think we would get back to this range already, and I'm astounded, along with everyone else. And so with a risk-on mentality, with stocks going up, it lessens the chance of there being a cut in June. This is highly expected. If the stock market goes up, the Fed can't cut. That's a key thing that they watch all the time. And you can see this for the June Fed funds futures. The chance of no cut went from last week of only 40% to yesterday 67% and continuing higher to 73%. No cut all the way through June, at least as it stands. If we get a rollover in markets and things start to plummet again, it's very likely these will then shift the other way, but right now they can't. Because we all know the Fed can't cut, stocks are too high. I think this stock market is controlling the Fed right now more than anything else. Will this last? I don't think so. We have some charts to look at. So stay tuned. Community topics. What moves, if any, did you make today? Robschild did nothing but sit on his hands. Comment below what you did today. Coming up later this week, and as always, continuous tariff updates. We also have Tuesday AMD earnings, which could really rock things. This is almost a $200 billion company in one of the, biggest sectors in stocks right now. There's a lot of wealth in semiconductors right now. And if these earnings aren't very strong, it has the potential to send the entire market going down, not just the semiconductors, because the semiconductors make up now a lot of the stock market by their market cap. And then Wednesday, we have FOMC. We have a bunch of Fed speakers on Friday as well, but the main stuff regarding that will happen Wednesday. And so there could be some interesting things said then. I think the Fed is really stuck in a situation as it stands right now that they really are forced to save face and be like, no, we can't cut. Inflation's not down. The stock market's up. Unemployment isn't skyrocketing, so why would we cut? Even though they see all the soft data coming in, with everyone worried about the future, with layoffs being reported left and right, with continued jobless claims. That's the first hard data piece that I talked about last Thursday. We made new highs, new multi-year highs in the continued claims. If that goes higher on Thursday, watch out. It comes out after, of course, the FOMC meeting on Wednesday. So that continuing jobless claims is a huge one for me. So look out for that. Before we get to the charts, thank you for watching. Thank you for subscribing, commenting, and supporting. Remember the subscription button. It's right over here. Just put your mouse over it and then you click subscribe. Also, if you want to support the channel, check the description. The details are here. All the support is very much appreciated. No changes in the daily reminders macro views. Click the link in the description of the video labeled daily reminders. It shows my website that breaks these very important things down. And no changes in the crystal ball readings nor the Robschild portfolio. Chartists better than me were looking for 5,700 on the S&P 500, which we did hit on Friday and back off from exactly that mark. Whenever we get to an important trend line, it's important to take a look at what's happening now. If things were going to be continuing to get bullish, we would really want to see a fight at the very top of this thing forming a bull flag to break out to the upside, and we didn't get that today. Instead, it's looking a lot more like the kind of thing that is a blow off top. This is looking like it's getting rejected. And so my viewpoint is we're looking to find some support level lower than here. It looks like things want to continue down just from a technical standpoint. There's not even a fight here. There's not enough buyers keeping this floating near this psychological level. And so the bears look like they're taking control here. Add to this the VIX went up a little bit today, not a ton, but remember, we're still above 20 and we're completely in backwardation on the VIX futures term structure. This is the VIX market saying very loudly, we're in panic mode right now. We're not, things aren't peachy. We aren't out of the woods. If you want to buy options contracts right now, they're a little more expensive than they normally are. TLT, my favorite place to be. I mentioned on Friday how the market found its bottom at this little trend line there. We broke through it to the bottom. It looks to me like we are headed back down to this gap fill area that was made at the beginning of the year in January 2025. We poked our heads in it a few times, but we didn't really have a battle here. I would expect at this point for us to get to this range and have a battle here before I assume heading higher. I mean, the only way rates can continue to go up is if earnings and guidance from companies just comes out like gangbusters. Like everybody's just, the companies are making tons of money, and yeah, then it makes sense for yields to go up. But yields, otherwise they have to go down. And with the tariffs and with consumer sentiment being so low, with, like I'm saying, continued claims starting to go up a bit. And then you may have heard in the news or other people talking about a lot of companies in their forward guidance is, what they say, hey, this is what we think our business is going to be like over the next year. So many companies now are just pulling guidance. They're like, we don't know what's going to happen. So a lot of uncertainty, which can actually cause the recession to happen itself. Markets aren't weighing machines, they're voting machines. And if everybody's worried and we vote stocks down, they go down. And along with that, companies spend less, people get laid off, people have to spend less. The whole thing, feeds on itself. And, that's what we have happen when you have lower rates. Rates are supposed to go down right now, not up. And so I can't imagine us fighting here and then bonds headed lower, but I'll eat my own hat at this point if TLT drops below 85.31 from here. I will be accumulating more treasury bond exposure in this area when we get there. One thing that caught my eye today with the market going down just a little bit, I wanted to see, what sectors are moving here. Energy really got the biggest hit. And actually, we had a little bit of a positive on consumer defensive. So there is a touch of rotation into more defensive areas, including basic materials, communication services, utilities, while financial, technology, consumer cyclical, and energy are all, getting hit just on the day. But you got to take this with a grain of salt, but still. I've already been talking about this a lot, but it's still very important to bring up the fact that crude oil is very, very weak. We haven't seen a price this low in crude oil since February of 2021. Now, have things gotten cheaper since 2021? Is everything getting cheaper since 2021? What's going on here? Well, OPEC apparently is saying we're going to make lots more oil to make sure Americans can't make any money fracking oil, because it has to be above basically $60 or $65 a barrel in order for that to be profitable. But on top of that, the amount that they're ramping up here, they're planning to ramp up like more and more and more production. it just tells me that OPEC is scared of global economic slowdown right now, and they're trying to make as much money as they can before they have to basically shut down oil production, not by choice, but by the fact that there is so little demand that it's forced on them. Next, I wanted to bring up Dr. Copper with a PhD in economics. All I can say is this chart pattern is starting to look a little more clear at this point, that after all of this whipsaw we had with the tariff announcements going on and then whipping back up, we're getting tighter and tighter here. We have like a big move, bigger move, then smaller move, and smaller move. And so Dr. Copper doesn't know what to do from here. If we do get like a more obvious signs, more hard data saying that we're headed into global economic slowdown, this will go down. It will not go up. For Dr. Copper to go up, there has to be demand for copper. And this comes from building infrastructure, producing cars, you name it, copper is involved. Next, gold. This was a little out of left field for me. I didn't expect gold to pop up today by almost 3%. Even more glad than I was before that I just jumped out of my short on gold. I think it was Friday. Anyway, at this point, we're in no man's land. I don't know where we're going, but I probably will short. I will short gold again if we get back up to the $3,500 level. It just seems too easy. Next, Bitcoin. I've been talking about recently how it looks like it is now struggling to get up to that $100,000 mark. We're at the point now where this bull flag is starting to look like bull nonsense. The longer a flag goes, the more it increases its chance of actually going the other way. Generally, you want to see like a week of a flag, so like 5 to 7 days. We're well past that now, so we're starting to look like there's less of a chance of Bitcoin really doing well right now. And this is in line with everyone and their uncle's expectation that, there's a slowdown coming. Crude oil, Bitcoin has become a very good leading indicator of global liquidity. When people have plenty of money, they're willing to put it into Bitcoin. When people need money, they're going to sell Bitcoin. It's not that hard to understand. I think we are preparing for a drop in Bitcoin personally, but I'm not betting on it. Next, SMH, Semiconductor Index. Like I said in previous shows, now that we ruined the bearish, the very, very strong bearish signals on the SMH, I'm going to be forced to exit my short once we get down to around the 212 area. I'm hearing chartists better than me seek out the upper range of 212, like 212 and change. So I'm looking, once we get down to 213, that's actually when I'm going to be exiting my short at minimal loss. Of course, it's possible that we'll slam right through there and go much lower, especially with AMD earnings coming out on Tuesday, but I think it's after the bell on Tuesday. So, for example, tomorrow, if we get down to this range below 113, I'll be selling my short before the AMD news comes out. Otherwise, I'm holding until we get to that area. Next, I want to bring up junk bond credit spreads, finding a new low that we haven't seen since, before the credit, the Liberation Day blow up. So we have Liberation Day on April 2nd, and then ever since then, we've been higher and higher, and then we just found a new low recently since going down. This can and does give more legs to the stock market to go higher, and I'm not believing it for a second. I think we are about to get much wider in credit spreads. Lastly, we did it. Reddit. We've somehow managed to get back into greed mode on the Fear and Greed Index on CNN Business. I've mentioned on the show numerous times in the past that you can't stay in extreme fear forever, and that it's normal in a bear market to go back to fear, go back to neutral, even get into greed. I don't think we can get into extreme greed from here. I think this is the end of this bull run. I think we're going to go straight back into neutral and make our way back to extreme fear in the very near future. But I don't know. What do I know? I'm just a guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.